You can see on your screens that what is the agenda of this session. The agenda of the session that is to discuss and practice the challenging questions of a previous attempts. Now, you guys must be aware of it that ACCA half yearly reveals the examiner report. Yes, half yearly reveals the examiner report, and in that examiner report, ACCA examiner specifically identifies the few challenging questions that was tested in section A and section B. In my opinion, these questions are those questions which were proved to be the challenging one for all the candidates who appeared in F7 financial reporting paper, which means those questions that was very difficult questions for all over the world, every students who appeared for the F7 financial reporting paper. So in this session, specifically, I'm going to discuss all of these questions. And remember, this is the practice to pass session. This is the practice to pass webinar. It means this is not a one-way communication. It's not the case that I'll be solving all the questions. No, you guys will be participating along with me. Inshallah, we will participate all together and we'll try to practice all those difficult or the challenging questions in the first half. Second thing is, second objective or agenda of the session, that is to identify or highlight the mistakes that the examiner has highlighted in the previous reports. Yes, we'll just discuss all of these questions and you will get to know it that these questions were not that difficult, but the students made silly blunders in those particular questions. So we will highlight all those mistakes. Why we are highlighting all those mistakes? So that in the upcoming attempt, you guys should not repeat those mistakes as already did by the previous students or the candidates. And third, the most important objective of this session of the webinar is there will be a quick revision of standards. I'm not here to solve the questions. I'm not here that I will solving all those questions and will say that is the correct answer A, B, or C. No, it's not the objective of this session. We are going to discuss the questions in details. Inshallah, we will be discussing that particular standard in detail. We'll have a quick revision of all those standards. So the questions we will be practicing, and after practicing all those questions, we will cover these standards like consolidation, ratios, IAS 40, IFRS 16, IFRS 5, IFRS 9, IAS 33, IAS 12, the most tough and the difficult one, and IAS 2, IAS 36, and IAS 20. So these are the standards that will be revised inshallah at the end of this session. So it's going to be the very constructive and the very productive session inshallah. And make sure that this session will be a two-way communication. I will not be the only person who will be talking about. I will not be the person who will be solving all the questions. You guys will also be participating along with me. So let's begin with the session without wasting the time and start with the first question. We'll read the question. I will try to give you an understanding of the question, and then we'll give you a brief introduction of that particular standard, and you guys will be practicing. Mark my words, this practice session is not for me. This practice session is for you guys. So you guys must be practicing, and please don't be demotivated if you'll not be able to attempt that question. Please don't be demotivated. Mark my words, as examiner has already stated, you can just go through the examiner's report. The first line of that examiner report is that these are the questions that prove to be the challenging one for the people or for the candidates or for all students. So make sure that these are the difficult ones, and if you are able to attempt and if you are able to answer the question correctly, it means congratulations, you are well prepared. But if you are not, then don't be demotivated. That session is being conducted only for that purpose, that you could identify your mistakes. Okay, question number 1 is on your screen. Let's quickly read out the question and we'll give you a brief introduction of that question, and then we'll try to solve and answer the question. Okay. For several years, Jaswinta company has applied the cost model to its investment property. Okay, now we are going to highlight that there is the term investment property, which means we are talking about which standard, in which standard we are going to jump in. Please comment through our chat box. I need your participation. Nice, very good, Bilal, very good, Asif. It's a standard IAS 40 that deals with the investment property. Perfect. Okay, investment properties. From 1st April 20X3, the fair value model was applied to the investment properties. Okay, Before we move on towards the option side, before we move on towards the requirement side, quickly evaluate. I will keep on repeating the sentence. This is a practice to pass. You know the answer of this question. You can get the answer of this question from the examiner's report, but that is not my objective to let you know the answer of that question. That is not my target. That is not my purpose, that I show you that what is the correct answer. I wanted to give you a quick revision of this IS 40. Okay, let's go and move on towards the IS 40 side. IAS 40 deals with investment property. Investment property, the subsequent measurement. All of you, please, now it's the end of the session. You are about to give the paper. You must know that there are two measurements. That is the initial and the other one is the subsequent measurement. The subsequent measurement allows you to continue with the cost model or to adopt the fair value model. Are you guys getting a point? Please be with me through our chat box. This session, this webinar should be a two-way communication. Perfect. Okay. Subsequent measurement could be either a cost model or fair value model. Let's quickly recap. What is cost model and what are the requirements of the cost model? The first requirement is the cost model, that you will be depreciating your assets as you were depreciating the other assets, other non-current assets. Second important point is, if you are using the cost model, any jump in the market value, any increase in the market value, no gain or losses are recorded. Am I right? Guys, am I right for this one? No gain or losses are recognized in P&L. Depreciation is recognized in a cost model, while no gain or losses in fair value. No gain or losses in fair value should be recognized. No gain or losses should be recognized in P&L. There will be no impact related to the fair value. Okay. Now, if we are going to move on towards the fair value model, if we just talk about the fair value model, in a fair value model, as per IS 40, we all know that no depreciation is calculated, guys. Exactly, Sahil. Perfect. Second thing is, yes, gain or losses on fair value. Gain or losses on fair value should be recognized or recorded in P&L. Nice. Very good. Perfect. Gain or losses on fair value should be recognized in P&L. Are you guys getting a point? Is it clear to everyone? Remember, we have not yet read the full question. Even we didn't move on towards the option side. Okay, now let's read out the question. On 1st April 20X3, fair value model was applied to investment properties. As fair values were greater than their carrying amount across all investment properties. And yes, we know that as per IS 40, if the company has decided to shift towards a fair value model, it means all all investment properties should be measured at fair value. While in IS 16, property, plant and equipment, there was an option given by the IS 16. If you want to adopt the revaluation model, you can adopt it, but the whole class of assets should be revalued. It's not the case over here. It means all investment properties should be measured at the fair value. So company has decided to move on towards the fair value model, and across all investment properties, there is a gain. How did I identify that there's a gain? That the fair values are greater than the carrying amount. It means there's a gain, and the fair value gain is $30 million, and it was recognized in this statement, financial statements. There has been no change in the useful life of the investment property. Now, let's read out the requirement of this question. What effect will this change in accounting policy? Yes, this is the change in accounting policy, IAS 8. If you're shifting or moving on towards from cost model to the fair value model, yes, it's a change in accounting policy. If you were using the direct method in a cash flow statement and now you have shifted towards indirect method, yes, it's a change in accounting policy. And if you were charging the depreciation in a cost of sales, now you have decided to charge the depreciation in operating expense. Yes, it's a change in accounting policy. Okay, that is a change in accounting policy. So what's the examiner is asking, that what effect will this change have on the financial statement for the year ended 31st March 20x4? Okay, let's move on towards the option side. Both operating profit margin and gearing. Okay, now guys, just look at the question requirement and the answer. Examiner was dealing with the IS 40, and once we moved on towards the option side, he just started with the concept of the ratios. Are you guys with me? That's why examiner said it's a difficult question. It's a challenging question. Two standards, two areas, two topics are tested simultaneously. IS 40 as well as the ratios. It means it's talking about the gross profit, operating profit margin and the gearing. And we all know that the operating profit margin and the gearing ratios, gearing is the part of your ratios topic. That is interpretation of financial statement. Okay. Let's quickly evaluate the option number one. Option A, both operating profit margin. First of all, we need to recall the operating profit margin. I told you it's a revision session. It's a practice to pass session. We're going to revise different standards, different topics, different chapters. The profit margin formula is, what is the profit margin formula is? PBIT, or we can say that the profit from operations. Am I right? PBIT or profit from operations divided by sales multiplied by 100. Am I right? Okay. And the formula for the gearing, let's also calculate or jot down the formula for gearing ratio. And you guys must be very champion, or you must recall or remind, or you should retain the formulas. As you guys know that in a section C, this area can be tested, and this will give free marks, and about 5 to 6 marks would be free for you guys if you have learned the formula by heart. Gearing ratio. The formula for the gearing ratio is, that is debt divided by debt plus equity multiply by 100. And sometimes gearing ratio is also applied or can be calculated as debt divided by equity multiply by 100. Is it? Okay, now let's quickly evaluate if the company is shifted from cost model to fair value model, what will be the impact? What will be the effect? First of all, now no depreciation will be recorded. And if no depreciation will be recorded, it means lower depreciation expense will be recorded. Are you guys with me? And if there will be a lower depreciation expense, it means there will be a, come on, reply me via chat box, guys. Excellent, Bilal. Very good. You can definitely respond me through a chat box. Operating profit margin, profit will increase. Profit will increase. If you're not recognizing the depreciation, once you are in a fair value model, definitely your profit will increase. And second thing is, under the cost model, you are not recognizing any gain or losses in a fair value. But now, since you have adopted the fair value model, and we have seen in the question, there's a gain of, I guess, $30 million. Yes. So you are recognizing a gain, which will definitely increase your profit. And remember what what normally I teach to my students, that whenever you want to give an analysis, you just go towards the formula side, man. That would be quite easy for you. There are two aspects. There are two sides. Number one is the numerator. This will help you out to comment in exams. This is the denominator. This is the denominator. Always remember, increase in numerator. Increase in numerator. Whenever there will be an increase in numerator, this will increase the ratio. This will increase the ratio. Yes, this will increase the ratio. It means the resultant of that ratio will increase. But remember, there's a vice versa. There is an opposite side. Increase in denominator. Increase in denominator. If the denominator is increased, this will decrease the ratio. The resultant will reduce the ratio. The resultant will be reduced. This will decrease the ratio. Are you getting my point? Let's quickly evaluate. If the profit margin, it means the numerator side is the profit, and we just evaluated that if no depreciation is recorded and gain or loss will be recorded, which means overall the profitability will increase. And obviously, if the profitability will increase, the numerator side will also increase, and ultimately this will give rise to the increase in ratio. While shifting from cost model to fair value model will not affect the denominator side. Am I right? Am I right? Great. Okay. So the resultant would definitely the operating profit margin will increase. Perfect. Okay. So it means option A is the correct answer. No. Let's quickly evaluate the other part of it. Gearing will also increase. Gearing will also increase. Okay, now let's evaluate whether the gearing ratio is increasing or not, and we'll finalize whether the option A is the correct answer or not. We are shifted from cost to fair value model. Will there be any impact on the numerator side? Please let me know through a chat box. Will there be any impact on the numerator side? No, not at all. Not at all, guys. Very good. Okay, will there be any impact on the denominator side? Come on. Let's participate. Perfect. Yep. Yes. Exactly. There will be an impact on the equity side. How? How there's going to be an impact on the equity side? Guys, if we are recognizing a higher profit, if we are shifted towards a fair value model, which means this profit will be transferred to the retained earning. And once it is transferred to the retained earning balance will increase. And we all know that the equity will increase. This retained earning will be transferred to the shareholders' equity. Sal, that's a very good point you have highlighted, man. Very good. I'll be coming on this one. Perfect. It means this will increase the amount of equity. And once the equity is increased, which means the denominator is increased. And I just told you guys, if the denominator is increased, the ratio will decrease. The ratio will decrease. Guys, are you getting my point? And here the examiner said that the gearing will increase. No, that's not the case. That's not the case. It means option A is not the valid one. One more aspect we can do it, man. One more aspect we can discuss on this one. But for that, I need your attention, please. I need your attention. I'm just moving on towards the ratio side, okay? That debt plus equity. There is another way to calculate this area. There is another way to calculate this area, man. If you want to calculate the debt plus equity element, there is another way. And what is that another way? The total assets. Just take the total assets from the balance sheet and eliminate or deduct the current liabilities. Am I right? Guys, do you remember that formula? Yes, yes, very good. Excellent, Sahil. Total assets minus current liabilities. And if you guys just observe this one, man, if we are moving on towards the fair value model, which means now the assets will be reported at higher value. There is a fair value gain of 30 million. It means under the fair value model, assets will be reported at the higher value. Am I right? Assets will be reported at the higher value, which means again, the assets will be reported at the higher value. And if the assets are reported at the higher value, again, the denominator is increased. Again, the denominator is increased. And once the denominator is increased, which means the gearing ratio will decrease. Are you getting my point, guys? Please notify me through a chat box. Am I clear to everyone? Perfect. So option A is not the correct answer. Option B. This option is going to be the correct answer? Please, I don't need any explanation for this one here. Guys, I don't need any explanation for this one. Is this going to be the correct answer? Not at all. Why? We never ever talk about the OCI in a IS 40. IS 40 never speaks about the OCI. If we are in a fair value model, we are never ever going to recognize, we are never ever going to recognize any gain in OCI. We will be transferring any increase or decrease directly to the P&L. Excellent, OAS, Zabardast, perfect. So the second option is invalid. Let's evaluate the third one. Profit before tax will increase. Now no discussion is required. We have discussed it in detail, man. Is this the correct statement? I'm just talking about this one. I'm just talking about this half. Please let me know. Is this the correct statement? Is this the correct statement? Yes. Profit before tax will increase because of two reasons. Number one, no depreciation is charged. Second one, gain on fair value is reported in P&L. Perfect. The other half, gearing will decrease. Is this the correct statement? Whether the second statement or the second part is correct? Yes, exactly. So we just found the correct option, and the correct option is C, that the profit before tax will increase and the gearing ratio will decrease. The D option is completely irrelevant or is completely wrong because profit before tax will not change. This is completely a wrong statement. There will be a huge impact on the profit before tax. Okay, guys, please let me know whether that question is clear to everyone or not. I tried my level best to give you an overview of IAS 40 and ratios. So the learning outcome for this question was to have a understanding of IAS 40 as well as the ratios. And I just give you a trick and tip that how you can comment or could find out the impact of the ratios, and that is the simple way, that is to check the numerator and the denominator. This will help you out in evaluating whether there will be a positive impact or the negative impact. Okay, let's move on towards the next question. I will share you this. I can share this file with you. There's no problem in it. So no need to copy that question. I will give my personal contact number to you guys. You can contact me out, you can reach me out, and I will definitely provide you with that file with that particular question along with the solution. So there is no need to hurry up while copying that question. Okay, let's move on towards the second question. Question number two. Kajak company manufactures canoes and kayaks for the European market. It is consistently a highly profitable company. Okay, this trend is expected to continue. Okay, most revenues is earned during the northern hemisphere's warmer months of March to August. That shows the examiner is discussing the seasonal industry. It's a seasonal industry, which means the higher profits or higher revenues are generated in fewer months or in a specific months. Higher profits or higher revenues or most of the revenues are earned from March till August. All sales are on credit for 30 days. The credit period is for 30 days. Upon incorporation, the company is being incorporated. Kajak company chooses between an annual reporting date of 31st January and 31st August. The company has to decide whether they want to have an accounting period ends on 31st January or on 31st of August. But the company decided or selected the 31st January as their accounting year end. First of all, please notify me through a chat box whether the question or the data is clear to you guys or not. The first thing you need to ensure that you must understand with the data that is given to you. The company has decided to incorporate, and while incorporating, they were given a choice that whether to select the accounting year end as 31st January or the 31st August. They selected 31st August as an accounting year end. But the point that should be remembered, that from the month of March till August, that is March, April, May, June, July, and August, these 6 months, they have a major revenues being generated, as that is the seasonal product. Okay, now let's move on towards the requirement side. Which two of the following would be true if Kajak company had instead chosen a reporting date of 31st August? Right now, we know that the company has decided to choose the 31st January as the reporting date. But examiner is asking, what if the examiner or the company has adopted the 31st August as the reporting date? Then which two of the following statements are true? Let's quickly evaluate the options. Option A, the statement of financial position as at 31st August would show Kajak company at its most liquid. Okay, before we move on towards the option side, that area of the question that the examiner has tested is definitely again targeting the ratio side. Am I right? That question is specifically targeting to the ratio side. The first statement that is given in the question, that the statement of financial position at 31st August would show Kajak company at its most liquid. First of all, if we talk about the liquid items, or the liquidity, for liquidity, we have two basic ratios, that is the current ratio and the quick ratio. Am I right? In order to calculate the liquidity of the company, we have two basic ratios, that is the current ratio and as well as the quick ratio. And if you want to calculate the current ratio or the quick ratio, the formula for that one is the current asset divided by current liabilities. And if you want to calculate the quick ratio or the asset test ratio, so current assets minus inventory. And in some books, we definitely deduct prepayments as well, divided by current liabilities. Now, what the examiner is saying in the option A, that the financial position at 31st August would show most liquid if the company had selected 31st August as the accounting year end, there would be a good liquidity position. How? Let's try to evaluate. I'm going to make a two timeline. First timeline that will end on 31st of January. Another timeline that will be ending on 31st of August. Majority of the sales are made in the month of, okay, first of all, if the 31st January is the year end, that will be starting from Feb last year. And the majority or the major sales are being made in the month of March, April, May, June, July, and August. Is it? Yes. These are the 6 months in which the higher sales or revenues are generated. But if we are following the another half or the another accounting period end, so this will be coming in the last months of the accounting period, March, April, May, June, July, and again August. So these are the 6 months, but these are the 6 months at the end of the accounting period. And these are the 6 months that are in a very initial stage, that is at the start of the 6 months. Now we all know that in the given question, examiner has already identified that the company made sales on credit and it's a 30 days credit period, which means if the company would have adopted an accounting period of 31st August, there will be a sales in the month of August, and that amount will not be received in that particular accounting period, and this August sales must have give rise to the accounts receivable. Am I right? Because there is a credit period of 30 days, which means the sales made out in the month of August, that amount was not recovered in the month of August, and this amount will be recovered after the period ending. It means this amount will be recovered in the month of September. That is the 30 days as the credit period. This will definitely give rise to the account receivable at the end of the reporting date. which shows that there will be a higher receivables at the end of the accounting period and once there is a higher receivable, which means the current assets would increase, and if there will be an increase in current assets, it means there will be an increase in numerator. Again, the same concept we are applying over here. And if there will be an increase in numerator, it means the current ratio or the quick ratio will increase, which will definitely increase the liquidity of the company. Are you guys getting my point? Are you guys getting the connection of it? Please notify me through our chat box. So that this shows that option A seems to be correct. As if the company would have selected 31st August as their accounting period, there will be an impact on the liquidity, and liquidity of the company would have been in a better position as compared to the 1st January. Reason being, if you talk about the 31st January, if you just talk about the 31st January, any receivables that has been generated in 6 months would definitely be recovered in that particular accounting period. And definitely in the upcoming 6 months, the amount they have received from those particular 6 month sales would have been spent out in different operating expenses, and there will be a lower cash balance or the account receivable balance at the year end. So definitely there will be an impact. Although the company has selected 31st January as the accounting year end, but what if the company would have selected the accounting period as 31st of August? There will be a higher receivable reported at the end of the year, which definitely will increase the amount of liquidity or the liquidity ratios. Is it clear to everyone? Okay, one more thing before moving on towards the next option. What will be the other impact of this accounting period? If the company would have selected the 31st August as their accounting period end, most of the inventory was sold out, and definitely there will be no need to repurchase the inventory in a bulk quantity, because the company knows that in the upcoming accounting period, like from August onwards, that is September, October, November, there will be a lower sales. There will be a lower sales in the upcoming accounting period. No, in the upcoming months. So definitely at the end of the year, when there is a season end, definitely the company would have lowered their purchases. Company would have lowered their purchases by the end of 31st of August. And if there will be a lower purchases, which means there will be a lower accounts payable. So at the end of the reporting date of the 31st August, it's a season end, and we all know that it's a practical insight. If there is a season end, definitely company would have lowered their purchases, as they know that in the upcoming months there will be a no higher sales, no revenues will be generated. So definitely the company would have a stop in their purchases. And if they have stopped in their purchases 1 month ago, which means there will be a low account payable that would be shown in the balance sheet. And again, if there will be a low account payable, so there will be a decrease in the denominator. Remember, there will be a decrease in the denominator, and whenever there is a decrease in the denominator, there will be an increase in ratio. Is this point clear to everyone? Please notify me through a chat box. I'm trying to discuss each and every aspects and details. Just wanted to revise or give you an insight, a clear insight of every particular standard or the chapter or the area. Okay, Ways, good, perfect. Now let's move on towards the B option. The time and cost. The time and cost of counting inventories should be minimized. Counting inventories, highlighting that word. counting inventories. Let's move on towards the IAS2. Counting inventories is also known as physical stock count. Physical stock count. And remember, physical stock count is a mandatory requirement. It's a compulsory requirement for all organizations. Whether you are following the perpetual accounting system or the periodic system, ISU states that physical stock count, physical inventory count is a mandatory or a compulsory requirement for all organizations. They need to conduct that exercise annually. The time and cost of the counting inventories should be minimized at or nearest to 31st August as compared to 31st January. Is this a statement seems to be true or false? Please notify me through a chat box. The examiner is saying that if we would have been following the 31st August as their accounting period, the time and cost for the physical stock count, the time and cost for the physical stock count would have been lower as compared to the 31st January. Is this a statement seems to be true or false? Please notify me through a chat box. If it is true, why? If it is true, why? If it is true, why? Please give me a reasoning or the explanation for this one. I want you all to participate. I want you all to participate in this session, please. Exactly at the end of the year and at the end of the season. Am I right? At the end of the season, most of the inventory you have sold out, man. At the end of the season, and that was the high sales because there won't be much inventory waste. Excellent. So it means at the end of the season, you will be having a low inventory level, and if you will be having a low inventory level, there will be a lesser or the lower time or cost will be required. Perfect. Which means second statement seems to be correct. Second statement seems to be correct. And in that particular question, we were asked or required to identify two true statement, and we can definitely find it out that is A and B are the correct statements. But now let's evaluate why not C and D. Why not C and D are the correct statements? The third statement says that the profit for the year ended 31st August would be higher than 31st January. Remember, there will be no impact on the P&L. Reason being, if we are supposed, let's take the timeline, the same timeline. 6 months revenues will be reported in the P&L, and here the 6 months revenue will also be reported in the P&L. So which means the revenues and expenses will be reported for the year. Remember, P&L is prepared for the year while the balance sheet is prepared as at and as on. Which means the revenues will be reported for the whole accounting period, and the revenues for that particular season will be reported whether you follow the 31st January or 31st August as your accounting year end. So there will be no impact on the profit. There will be no impact on the profit whether you choose 31st August as your accounting period or 31st January. Last one, that is the cash generated from the operation would be higher. No, this will not be the case, as the cash generated from the operations will be again for the period. Cash generated from operations for the period, same cash will be generated from the period. So it means there will be no impact on the cash flows or on the profitability of the company, whether you use the 31st January as your accounting period or 31st August as your accounting period. So learning outcome of this question that you need to remember, that if the examiner is talking about the seasonal industry, you need to remember this one. You need to jot it down that there will be an impact, the major impact on the balance sheet side. And specifically, there will be a very big impact on the liquidity of the company. Please remember this one. Examiner might ask you a question similar to that one. He may raise a question related to the seasonal industry or the seasonal business. So you should remember this one. These points are relevant for the ratio analysis as well. The examiner might give you a scenario for a business that relates to the seasonal business or the seasonal product. So you need to remember all of these points. I hope that question is clear to you guys. Is it clear to everyone? Shall we move on towards the next question? Even I would rectify my statement. We are moving on towards the next challenging question. Okay. Much awaited question. The favorite area of every student or the candidate. Babur company acquired 60% of rented company. First of all, from which topic or the standard, from which topic this question has been extracted? Please notify me through a chat box. I need your active participation. Exactly, consolidation, the most favorite area of examiner as well as for the candidates. Consolidation. Okay, let's move on. Let's read out the data. Berber Company acquired 60% ordinary shares of rented company on 1st of April. It means rented company is a subsidiary and Berber Company is a parent company. On 1st of April 2006, I always ask my students, whenever you see the date of acquisition, just move on and jump towards the date of reporting in order to identify whether there is a immediate acquisition or not. Okay, 1st April 2006 is the date of acquisition and the date of reporting is 31st of March 2007. It means it's not a immediate acquisition question, it's a full year accounting question. It's a full year question. Okay. On that date, which means at the date of acquisition, the carrying amount of the rented company's net assets equal to that of the fair value except for the property. Perfect. Rented company property with a carrying amount of 18 lakh had a fair value of 32 lakh. That is 3.2 million is the fair value, although the carrying amount is 18 lakh, which means we can calculate the fair value or the revaluation surplus of it. Exactly the same situation is. Carrying amount is 18 lakh and the fair value is 32 lakh. And the remaining life is 50 years. This is the only property within the Berber company or the Berber group. What is the impact of the fair value adjustment on the Berber's group's consolidated retained earning? Please, there could be multiple requirements of it that examiner might have asked you. For example, the examiner might have asked you at what amount the property should be valued in the consolidated statement of financial position. What should be the amount of gain on revaluation should be reported in balance sheet. But right now the question is you need to calculate the group retained earning, the consolidated retained earning. Now, how we are going to calculate it? First of all, let's recap the area. We know that while we are consolidating, IFRS states that the subsidiaries net assets should be valued at fair value, or we can say that the market value. Is it? And once we are recognizing or we are recording the net assets of a subsidiary company at a market or the fair value, definitely we'll be recognizing a revaluation surplus in the net assets of a subsidiary company. Reason being, in the individual accounts of a subsidiary company, that revaluation surplus was not recorded. And once we are recognizing the revaluation surplus, the accounting entry would have been PPE or the property, plant and equipment debit, and revaluation surplus will be credited in the books of a subsidiary company. And once we increase the value of a property, plant and equipment, we all know that the depreciation will also be recognized. Depreciation expense will also be recognized in the books of a subsidiary company. Is it clear to everyone? Yes, students, candidates, please answer me via chat box. Reply me through a chat box. Perfect. Okay. So if we are recognizing the depreciation in the books of a subsidiary company, we all know that the subsidiary of a company, the depreciation expense will be recorded in the books of a subsidiary company. This will impact the retained earning of a subsidiary company. And if the retained earning of a subsidiary company will be affected, this will or this could be found in a working of net assets. I've just given you a trail of it, just given a trail of it, man. You can just see on the screen that I have given you a trail of it. I would suggest you to please recap that trail, whether you're getting the point or not. Okay, is it clear to everyone? Is it clear to everyone? Okay, now let's first of all calculate the revaluation surplus. What is the amount of revaluation surplus? Please calculate the amount of revaluation surplus. Please calculate the amount of revaluation surplus. What is the value of revaluation surplus? Is it given in the question or we need to calculate it? Kindly provide me or calculate the amount of revaluation surplus is, that is 32 lakh minus 18 lakh. 32 lakh minus 18 lakh. Exactly, Yasi. Very good. That is 1400. 1400, which means 14 lakh is the amount of revaluation surplus. And we need to depreciate it over a period of 50 years. And it's a full year acquisition. It means there is no need to proportionate that depreciation. So what will be the amount of depreciation? Please, what will be the amount of depreciation? What will be the amount of depreciation? Fair value depreciation would be 28,000. Thank you, Bilal. Very good. Ois, Hasib, Naveen, 28,000. Okay, now let's move and just have a working of net assets. We have three different columns, that is at reporting, at acquisition, and then post. Is it? We don't have right now a share capital and we don't need even a share capital. Okay, second thing is we need to have a fair value adjustment, that is the revaluation surplus. This will be reported at acquisition. This will be reported at acquisition, that is 14 lakh. And same amount will be posted at reporting. So the post column would be 0. Then we need to calculate the depreciation, the fair value depreciation. And the amount of depreciation you guys have calculated, that is 28,000. And this will be adjusted. Remember, this will be adjusted in the column of reporting and not at acquisition. So the resultant would be 28,000 in negative. There is no as such adjustment, and we all know that the total of the post column, that is 28,000 negative, will be proportionated in two zones. That is, first of all, the 60%, 60% and the 40%. 28,000, 60%. What will be the amount of? That is 16,800. Exactly. 28,000 into 60%, which will make 16,800. And we all know that this will be transferred to the group retained earning. Am I right? Can you guys recall this one? Okay, let's calculate the group retained earning. The formula for the group retained earning is parent plus subsidiary, and it's a 60%. Right now, we don't have a retained earning of parent company. An examiner has not asked you regarding the total or the group retained earning balance. The examiner has only asked you that what will be the impact of the fair value adjustment on the group retained earning. The first thing that you need to keep in your mind, that there will be no impact of the revaluation surplus on the group retained earning. But yes, there will be an impact. There will be an impact of the fair value depreciation on the group retained earning. It means 16,800 will be transferred to the group retained earning. My question is to you that yes, 16,800 is the correct answer, but my question is that whether it will be charge or credit. Examiner has not given any option for this one, but I just wanted to test your understanding that whether it will be charge or credit. That's 16,800. For instance, the examiner has given you two options, that 16,800 charge and the B option is 16,800 credited. So what options you must have selected? Yes, this should be charged to P&L or charged to the group retained earning. So 16,800 is the correct answer. I don't remember the name of the student, but one student gave an answer for 28,000 when I was discussing the question, and examiner has identified in their examiner report that majority of the students selected that answer and they just forgot to proportionate that amount, as the full amount will not be transferred to the group. That is the blunder made out by the majority of the students in that particular exam. Remember, this is the past paper question. Examiner has identified majority of the students forgot to apply the acquisition percentage on that particular amount. Is this question clear to everyone? Please notify me through a chat box. And shall we move on? Okay, let's move on towards another question. And again, not the question, but the challenging question. Question number 4. On 1st of January 2006 or 16, Causeway Company acquired property through a 7-year lease. 7-year lease. The following information is relevant. Okay, first of all, please notify me in which standard we are right now. Which standard we are going to discuss now? IFRS 16. Perfect. It's IFRS 16. Leases. Leases. Okay. Let's read out the data. On 1st January 2006, an initial lease payment of $6 million was made. $6 million was paid at the inception, at the start of the lease. Annual lease payments of $12 million are due on 31st December each year. Now there is a confusion. What is that particular confusion? If the company has made an initial lease payment of $6 million at the start of the lease agreement or the inception of the lease, it seems like it's an advance question. It's a question of advance. You guys must remember this one, that whenever we talk about the finance lease, there might be two conditions or the two scenarios that examiner might test you. One is the advance case and the second one is the arrears. What is the difference between these two? In case of the advance payment, the lease rentals are paid at the start of the year, while in case of arrears, the lease rentals are paid at the end of the accounting period. Once we read out the first information, it seems like it's an advance question, but subsequently it was cleared or clarified by the examiner that annual lease payments are paid at the end of the accounting period. That shows it's an arrears case. But if that is the case for the arrears, so what is that 6 million? That is the first down payment or the advance paid by the company. That could be an option. That is the possibility. The company paid the first rental in advance of 6 million. Otherwise, and other rentals will be paid on yearly basis at the end of each year. Interest rate implicit in the lease is 5%. The present value of lease payment on 1st January before the initial lease payment, that is 75 million, and that is the present value of all lease payment. That is the present value of all lease payment. It means the first rental is included in that particular amount. That is inclusive of that particular 6 million. That is the total present value of lease payment. I can provide, Noor, I will be providing you that recording. Don't worry about this one. You just focus on the concept right now. I'll be providing the recordings of that particular seminar or the webinar. Please don't panic for this one. You just concentrate on the concept right now. Okay, that is the present value of all lease payment. Now what will be the finance cost? What will be the finance cost in respect of the lease? Okay, we need to calculate the finance cost. In Causeways Company's statement of profit and loss for the year ended 31st December 2007. Remember, and I will inform you, I will let you know about the blunders that is made by the majority of the candidates. It is, I would say it's an easy question. It's an easy question, but majority of the students made the blunder. The lease was started on 1st of January 2006, and the P&L extract or the finance cost is required for the year ended 31st December 2007. That is at the end of the year 2. Okay, now let's try to solve this question. What I usually do, I make a format of the table. That is the year. Second column is the opening. Second column is the opening balance. Or we can simplify this format. We can simplify this format. We can simplify this format for this question. We can simplify this format. We can simplify this format. That is year. And then we can have rentals. We can have rentals. Then finance cost, principal amount, and then the closing balance. Year, rental, finance cost, that is the interest expense, principal amount, and the cash balance. Okay. Lease agreement was started on 1st of January 2006, and the balance was 75 million. That is the total lease payment. That is the total lease payment. And on the same day, we paid a rental of 6 million. We paid a rental of 6 million at the inception of the lease. Now my question is, and the basic concept of the financial reporting or the accounting, always remember, interest is calculated. Interest is always calculated or recorded if the loan amount is due for the whole year. So far, on 1st of January, if I'm paying a rental of $6 million, please let me know whether there will be any interest component in this rental. Whether there will be interest component in this rental. Not at all. Very good ways, Naveen, Hasib. There will be no component of interest. Reason being, that is the first day of the lease agreement, and so far the liability was not outstanding. So it means whatever the amount is paid will be considered as the principal amount. Can anyone please calculate the remaining liability? Can anyone please calculate the remaining liability of it? 75 million minus 6 million. 69 million. Is it? 69 million is the remaining liability. Now, the first or the second rental will be paid on 31st December 2006. 31st December 2006. Now the subsequent rentals are, the amount of the subsequent rental is 12 million. Few students made the blunder in that particular exam. They took the same rental as it was the first one. Examiner has identified this error. They were in a flow, and I don't know why they were having a very, they were very impatient, and they just took the 6 million as the second rental. While we know that in that particular question, examiner has identified that the annual lease payment would be 12 million that would be paid at the end of the accounting period. Okay, now, in that particular rental, whether there will be any interest component, Yes, there will be an interest component. And how are we going to calculate? The 69 million is the total liability that remained unpaid throughout the year from 1st January till 31st December. And if the liability remained outstanding or unpaid during that accounting period, there will be an interest, and the rate of interest is 5%. So 5% is 3450. 3450. Am I right? 3450,000. 34,50,000. 34,50,000. And out of 12 million rental, if 34,50,000, if 34,50,000 is the interest element, which means we have paid certain amount of principal as well. Always remember, in an annual rental, we usually pay two parts of that lease arrangement. Number one is the finance cost, and second one is the principal amount. Can anyone please calculate the amount of principal we have paid in this particular rental? In this particular rental, what amount of principal is being paid by the company? Yes, that is 85,50,000. 85,50,000. Which means 69 million minus 85,50,000. Now the remaining liability is 604,50,000. And this is not the end. We are not going to end this table over here. Reason being, the requirement is for the 31st December 20X7. We need to continue this one. Again, the another rental would have been for $12 million. Definitely, we have paid certain amount for the finance cost. And the interest element will be charged on that unpaid liability or the outstanding liability. Am I right? That is 604,50,000. 5% will be applied on that particular amount. That was the amount that remained unpaid or outstanding throughout the period. So what will be the finance cost? Please calculate the finance cost. Yes, this would be 30,22,500. And yes, those who are rounding off, that is 3023. So in that particular rental, 30,22,500 is the finance cost. So what amount we have paid? What amount we have paid for the principal value? That would be 89,77,500. So the remaining liability at the end of the accounting period would have been 60,450,000 minus 89,77,500. This will make 51,472,500. Okay, now you guys will be giving me an answer for this question. You guys will be giving me an answer for this question. The requirement is, what will be the finance cost in respect of the lease? What will be the amount of finance cost? Yes, I need your participation. The working is in front of you. You can see the working. You can see the lease amortization schedule. What will be the amount of finance cost that would be reported? Yes, it's 30,22,500. That is the amount should be reported in the finance cost and the P&L for the year ended 31st December 2007. Examiner has highlighted the error that majority of the student reported the answer or they posted the answer for 3450. They didn't read the requirement properly. Although it's written that you need to calculate or find the finance cost for the year 2. So the correct answer that would be reported in P&L is 30,22,500. 22500. One more thing that you need to consider this one, that the empty blank was given over there, and if nothing is mentioned or written in front of that particular empty blank, you have to type the value, complete value, complete value. Please don't do that. That if you will be typing 30225, this will not reward you the marks. This will not reward you. If you have typed 3 or 30 million, 30 million, no, this would not be the correct answer. But yes, if there's a blank and triple zeros are already written soon after the blank, which means now you can eliminate and you will be showing your working or the answer in thousands, like many students did this, 30225. Now that would have been a correct answer. Are you guys getting my point? These are the silly and a very, very, very minor mistake. You have done everything perfect, but you posted the wrong answer in that particular blank. Is it clear to everyone? Please notify me through a chat box. Okay, one more requirement. I just wanted to test your understanding. If I just ask you and modify the requirement of this question, and I've asked you what will be the long-term liability that should be reported in the balance sheet at 31st of December 20x7. Can anyone give me the answer of this question? Please try this one. As I told you earlier in this session, at the start of the session, we are not going to identify or to just tick mark the correct answer. No, this is not the objective of this webinar. The objective of this webinar is to give you an understanding, is to revise the standard, is to take the different aspects of this standard, that what examiner might ask you in relation to that question. So please work out and try to calculate the value of a long-term liability at the end of 31st December 20x7. Ois Raza. Okay, we'll try to find out. Okay. Everyone, please try. Everyone, all of you are requested to please participate. This session is not for me. This session is for you guys. Okay, let's try to calculate this one. For this, we need to move on. We need to move on, and we need to drag this working, and we'll have to move on towards 31st December 2008. Again, a 12 million rental will be paid at the end of the year 8. And again, the interest will be calculated on the amount of 514,72500, and 5% interest will be charged on this one. This will give rise to 2573625. Again, 12 million rental was paid, out of which 2573625 is the interest amount. So the principal amount paid was 9426375. So the balance liability would have been 514,72500 minus 9426375. So the remaining liability would have been 420,46125. And if we talk about the year end 31st December 20x7, that is the total liability at the end of the 20x7. That is the total liability. That is the total lease liability, out of which the sum amount will be paid in the next 12 months. Am I right? Some amount will be paid in the next 12 months, and the balance amount will be paid after the 12 months. So 42046,125 is no doubt the long-term liability, and 9426375 is no doubt the current liability. Is it clear to everyone? If you talk about 31st December 2007, what amount of finance cost to be charged to PNL? 3022500. What amount of total liability to be reported in balance sheet? 5.472500. What amount of current liability to be reported? 9426375. And what amount of long-term liability would be reported? That is 42046125. Is it clear to everyone? Okay, shall we move on? Shall we move on towards the next question? Oh, the difficult one. Okay, now moving on towards the next question. That is the OT case. That is the OT case. And again, examiner has identified that this was the challenging one for many candidates who were appearing in that particular attempt. Who appeared in that particular attempt, and this was the challenging question for them. Okay, now let's read out the question and the data, and we'll try to evaluate which standard the examiner is testing right now in this particular OT case. Okay, Gammon Company manufactures and sells a wide variety of furniture. Its year-end date is 31st of October 20x4. During the year, Gammon Company commenced restructuring. The word restructuring. And the word restructuring, we have heard that restructuring terminology in which standard? In which standard? In which standard you have heard about this terminology? IAS 37. Very good, Asif. IAS 37. Restructuring is the concept that was discussed in IAS 37. Very good. As part of this, the garden furniture division was classified as held for sale. Okay. Company has decided to restructure the system or the company. And as a part of this restructuring, the company has decided that the garden furniture division was classified as held for sale. There is a specific division and the company has decided to classify as held for sale. The garden furniture division was sold on 12th of January 20x5, which means soon after the reporting period. The reporting period ends on 31st of October 2004, and the furniture or the division was sold on 12th of January 20x5. Prior to its classification as held for sale, the division's current assets were realized and proceeds were used to settle its liabilities. Relevant information to the non-current assets of garden furniture division. It means that particular division's details are given below. At 31st October, that is at the end of the accounting period, when that particular division was classified as held for sale. Remember, it was not sold on 31st of October. It was sold soon after the reporting date. Okay. Now the details of the assets are given below. That is the carrying amount of that division, which is held for sale, the value in use, the fair value, and the selling cost. On 1st of August 2004, which means during the period of this accounting period, to partly fund the restructuring, definitely restructuring will cost you. So the company has made certain financing arrangement. 18 million equity ordinary shares were issued at a full market price, at a market value. And 18 million ordinary shares were issued during the accounting period. Second, $60 million, that is the amount. $60 million, 8% convertible loan notes were issued at par. The effective rate is 8%. In order to finance the restructuring, what company did actually? Company issued 18 million ordinary shares at full market price. Secondly, company issued convertible bonds at the rate of 8%, and this amounted to $60 million. Additional and the relevant information for Gammon Company. 60 million ordinary shares were in issue on 1st November 20x3. And what is that 1st November 20x3? It's the start of the year. It's the starting period. It's the start of the year. On 1st March 20x4, that is during the period, a 1-for-4 bonus issue, 1-for-4 issue of bonus shares were made. It means during the accounting period, we issued certain ordinary shares at a market value. Subsequently, we also issued, moreover, we also issued bonus shares during this accounting period. Profit from the year from continuing operations amounted to $103.8 million, and the income tax rate is 20%. Quite difficult one. That's why the examiner said it was the challenging scenario. It was a challenging scenario, not only for you guys, but for the majority, but for the masses. Okay, that was the data. If you just evaluate the data, few standards that examiner has tried to target it. Number one, that is IAS 37. It just talked about the restructuring cost. Second is the most important, IFRS 5. And the third, we can see that the shares are issued. Some shares are issued at full market price and few bonus shares are issued. And we know that the relevant standard for this issuance of shares is IAS 33. Am I right? EPS. Yes, very good. So mainly these standards are discussed in that particular scenario. But let's read the requirement. Let's read the requirement or the question. The data relates this data relates to the question number 5 till question number 9. So let's read out the question number 5 first. Assuming it has been sold in the reporting period, which of the following would meet the definition of a discontinued operation in accordance with the IFRS 5 non-current asset held for sale? Non-current asset held for sale. Now, I think what I believe that this was the easiest question and it was a theoretical one, but would have been a curse for those students who just left out the theory area. Many of the students comes to me and they ask me that whether the theory is important or not. I say that that is very important, and believe me, that was the very simple and a very easy theory that has been tested in that particular exam, and the four easiest marks, four easiest, question number 5 and question number 6, that is related to IFRS 5, and that covers the theoretical area. Before I move on towards the correct answer, let me recall IFRS 5 for you. Let's take 5 to 6 and 7 minutes and let's recall the whole standard of IFRS 5. Let me give you a very brief understanding of that particular standard, IFRS 5. IFRS 5, the title of this standard is that is non-current asset held for sale. And there are two aspects that has been discussed in this particular standard. Number one, non-current asset held for sale. And the second one is the discontinued operations. Let me give you a brief insight of this particular accounting standard so that your each and every area and the theoretical area, especially the theoretical area, will be recalled. Non-current asset held for sale. First, evaluate this one. What is this non-current asset held for sale? Any non-current asset that is held for sale, IFRS 5 states that if any non-current asset that is available for immediate sale in present condition. In present condition. Now, what does it mean? It means if you have any asset, for example, furniture, equipment, or machine, and if you wanted to say that that non-current asset is held for sale, so the first criteria is that such asset should be available for immediate sale, as that asset is in present condition. Don't say this that we will modify that asset and we will sell. No, if that asset is available, immediately available for sale in the present condition. And the second criteria is the sale is highly probable. The sale is highly probable. Now, what is the definition of highly probable? IFRS 5 quickly states that the sale is highly probable means you have started to locate the supplier, locate the buyer. You have started your working, you have marketed that asset. You have given the information to different agents, and you have started to locate the buyers, and the sale must be expected to be completed, expected to be sold within 12 months. Within 12 months. There are other conditions or criteria too, but these are the two most important characteristics that the sale is highly probable. If both of these criteria are met, yes, now you can recognize that furniture. Now you can recognize that furniture not as a non-current asset, but now you can recognize that furniture as a non-current asset held for sale. Held for sale. This means that you will be transferring the furniture, the property, plant, and equipment to the non-current asset held for sale, and the property, plant, and equipment will be credited. Property, plant, and equipment will be credited in normal situation or the circumstances. Which means that non-current asset held for sale will be recognized as a current asset. Will be recognized as a current asset. Now you'll be transferring that asset, furniture, from non-current asset to the current asset, and the title would have been non-current asset held for sale. Now, at what value such non-current asset held for sale should be recognized? For that purpose, IFRS 5 has given you a rule, that is, it should be measured at lower of carrying amount, and the other is the fair value less cost to sell, whichever is lower. Carrying amount or fair value less cost to sell. And the second important rule is, as this asset will be converted or transferred to the current asset account, now no further depreciation will be calculated. No depreciation will be calculated. That is the summary I'm giving you. That is the overall summary of IFRS 5. Non-current asset held for sale will be recognized to the lower of carrying amount or the fair value less cost to sell, whichever is lower. If the fair value less cost to sell, if the fair value less cost to sell is lower, for instance, let's take an example. We were having a property, plant, and equipment. The value of that property, plant, and equipment was 2 million, let's say 2,000. And now we are going to transfer that property, plant, and equipment to the non-current asset held for sale, and the fair value less cost to sell, that is the carrying amount. Fair value less cost to sell is 1,000 or 1,500, or let's say 500. 500 is the fair value less cost to sell, which means the carrying amount is 2,000, fair value less cost to sell is 500. It means now the asset will be transferred to the value of 500, which means non-current asset held for sale will be debited by 500, but the property, plant, and equipment will be credited by 2,000 as it was recorded in the balance sheet at the value of 2,000. Now the difference of 1,500 will be charged to P&L, and that is known as what? The impairment loss. Remember, if you just look at the scope of IAS 36, impairment of asset, IAS 36 has clearly identified that the impairment related to the non-current asset held for sale is not dealt according to the IAS 36. Instead, the treatment of such impairment loss related to the non-current asset held for sale will be considered or explained in IFRS 5. So that is the IFRS 5 that gives you an insight that the difference amount will be charged to P&L. Okay, that was the entry for the transfer of property, plant, and equipment to the non-current asset held for sale. Okay, now few disclosures are also required. Related to the non-current asset held for sale. First thing is that is the description of the asset, the name of the asset, description of the asset that was transferred as a non-current asset held for sale. Second, the facts and the circumstances, that what are those or what were those circumstances like restructuring or any other fact or the circumstances because of which you have transferred that property, plant, and equipment to the non-current asset held for sale, or any gain or loss you have recognized so far on that reclassification. Is it clear to everyone? I'm trying to recall you. I'm trying to give you an understanding or the revision or the quick insight of IFRS 5. As a broader aspect, in this particular standard, the treatment related to non-current asset held for sale and a treatment related to discontinued operation is discussed in that particular standard. Is it clear to everyone? Please let me know. Is this clear to everyone? Please notify me through a chat box. Okay, now let's move on. Let's move on. Discontinued operation. Let's move on towards the discontinued operation. Let's move on towards the discontinued operation. Discontinued operation. What is discontinued operation? IFRS 5 states that, and please mark my words, this is one of the most important area. Usually, candidates do not look after that particular IFRS 5. They are focusing more on the consolidation, final account ratios, IFRS 9, that is financial instrument. They are focusing more on these standards. That is the standard which is usually omitted. This is the standard. Usually students don't focus on this one. It's my request. It's my request to you. Please focus on this standard. Recently, what I have observed from the examiner's approach, now examiner is targeting on those particular standard which usually candidates do not look after it. Like in the recent attempt, IAS 41 agriculture. Usually students don't focus on this standard, as this is very small standard, and they don't learn the theory of it. But in the last or the previous attempt, examiner tested a full-fledged question of 10 marks in an OT case, in one of the OT case. Likewise, IS 33 EPS. So these are the standards. IFRS 9, these are the standards. No doubts, these are very short and precise, but an important one. So please, that is my objective. That's why I'm giving you a brief overview of that standard. Discontinued operation. Now, what is discontinued operation? As per IFRS 5, any component of an entity disposed of, any component of an entity disposed of or classified as held for sale. First of all, what is the discontinued operation? Any component of an entity, any component. I will define this one, what the component means. Any component of an entity disposed of, either you have disposed of or you have classified that component as held for sale. Now, what does it mean? The first thing that you need to account for, that the component means a separate major line, the separate major line of business, the separate major line of the business and or geographical area. It means that is a separate major line of the business or geographical area. For instance, if there is a company that is, let's say, a Unilever has decided to discontinue the operations. Overall, no. The Unilever has decided to discontinue the operations and they wanted to discontinue the Lux product. They wanted to discontinue Surf Excel. They wanted to discontinue one line that is the major line of the business. It could be a product. It could be any area. For example, Unilever has decided to discontinue their production line that is situated in Multan or in Karachi or in any other city or in any other country. So that is the discontinuation of what? The major line of a business or a geographical area. That you are discontinuing the major line of the business or you are discontinuing the geographical area. But this is not the only case. Such discontinuation must have a plan. There should have be a plan. There should be having a plan. There should have a plan. And that correspond with the IS 37. If you just recall the IS 37, the restructuring provision should only be recorded if you have a detailed formal plan. So that is what the IFRS states, that you are discontinuing the separate business major line, or you are discontinuing any geographical area, number one, and you have a plan for that. You have a plan for that particular discontinuation. You have a plan for that particular discontinuation. The originate plan, the word originate plan, the terminology used by the IFRS 5, that is the originate plan. You must have originate plan. So this will be known as what? The discontinuation. Second part, that if you have purchased any subsidiary, if you have acquired subsidiary acquired exclusively for resale purpose, this is under the definition of discontinued operation. This will also be considered as a discontinued operation. Remember, IFRS 5 has already stated, if the component of an entity disposed of, either you have disposed of or you have classified that asset as held for sale, both will be considered as a discontinued operation. When there are 2 points. Number one, if the major line of the business or the geographical area you have decided to discontinue, and the plan and there is a plan for that particular discontinuation. Second, that is, or the subsidiary acquired exclusively for resale purpose, then this will be known as what? The discontinued operation. Now the question arises, what would be the accounting treatment for this one? Remember, if we talk about the non-current asset held for sale, such non-current asset will not be further recorded in the property, plant and equipment. Instead, this will be transferred to the non-current asset held for sale as a current asset and will further not be depreciated, and every year it will be tested for impairment. I'm not going deeply in the calculation of impairment. Every year impairment will be tested. That is the accounting treatment for non-current asset held for sale. Now, what is the accounting treatment suggested by the IFRS 5 for discontinued operation? If there is a discontinued operation, now the separate line item will be calculated, and there will be an impact on P&L, as well as there will be an impact on disclosures. Now, what will be the impact on P&L? Post-tax profit or loss from discontinued operations will be recorded. Post-tax profit or loss from the discontinued operation. When we will be preparing the P&L, we will calculate the profit. Profit after tax. We will calculate the post-tax profit. We will calculate the post-tax profit from discontinued operation, and we will show that line item separately in the income statement. If I will get the time at the end of the session, I will show you the format or the performa of that particular income statement, in which we will show a separate line item, that is the post-tax profit from the discontinued operation, and we will show that particular amount. So what would be the accounting treatment? If you have disposed of or you have classified that particular separate major line of the business as held for sale, what we will do, we will calculate the post-tax profit of that particular discontinued operation, and we will show that amount in the income statement as a separate line item in the P&L. Is it clear to everyone? Please notify me through a chat box. Okay, perfect. Not only this, once you have calculated this one and this will be shown on your P&L, now you have to give the analysis of that particular line item. No doubt the profit or losses are calculated by eliminating or by deducting the revenues and expenses, is it? So you have to give the analysis in the disclosures, in the notes to the accounts. And what are those analysis? That you need to give an analysis for the revenues and expenses of that particular discontinued operation. Second, you need to give the details of the related income tax as the post-tax profit or loss will be included in the P&L. So you need to give the information in the disclosures, in the notes to the accounts, the related income tax. And the third one is the gain or loss that arises on measurement or disposal. You need to give the details related, although all of these informations are already been accounted for in that particular value, in that particular line item. All of these line items, all of these informations are already available in that particular line item, but we want to show the complete analysis of that discontinued operation. So we will not be doing that calculation, or we will not be presenting all of these on the face of P&L, but we will be showing all of these analysis in the disclosures or notes to the accounts. Why we are doing? Reason being, if any of the stakeholder, the shareholders, is viewing your profit and loss account, so he will get to know about this one, that these are the profit that we will not be earning in the next accounting period for the analysis purpose. So these were the profit, that was the profit after tax we will not be earning in the next accounting period. That was the last year. That is the last year that we have earned that amount. So that's why we are calculating the profit from discontinued operation separately and recognizing that profit from discontinued operation as a separate line item. Is it clear to you guys? Please let me know through our chat box. We had a detailed discussion. We just had a detailed discussion of IFRS 5, and I just tried to cover the 100% standard. Okay, perfect. After having a very detailed discussion of that IFRS 5, now let's move on towards the question. Let's move on, and I'll really appreciate you guys if you will answer this question. If you will answer this question, that question number 5, please. That question number 5, please answer this question. I want everyone to participate. As I told you, this session is not for me. This session is for you. Okay. Good. Please try. At least try. Wait, you said both 1 and 2. You said both 1 and 2. Let's evaluate. Okay. A component of an entity that represents a separate major line of the business. Whether this statement is true or false. Does this fulfill the criteria or the definition given by the IFRS 5? Yes, it's true. A component, the separate major line. Other terminology that examiner might have used in this, that is a geographical. Please remember, examiner might ask you, instead of using the word the major separate line or the separate major line, examiner might use the terminology of the geographical area. So please remember this one. So that is the correct statement. It's perfect. Whether the statement 2 is correct, please, OS Raza, please read that information carefully. Read that information carefully. Whether it fulfills the criteria of the definition of a discontinued operation? This does not fulfill the criteria of the definition of a discontinued operation. Reason being, yes, Mr. Weiss. Oh no. And majority of the students, yes, exactly, Weiss. You are good, perfect. And majority, Weiss, please don't regret, don't be demotivated. You are in one of those who made that blunder in their papers. Majority of students marked the answer as C, that both 1 and 2. They just
Yes,
forgot
sir.
that this is an associate, and we know that this option could have been this option could have been correct if the word subsidiary is been written over there. Am I right? So option A is the correct answer for this one. Option A is the correct answer for this one. Now, after having a very detailed discussion on IFRS 5, I want you all to please answer that another question. I will not be guiding you now. I will not be helping you out anymore in this question. Please read the question and the requirement and let me know the answer of this question. Let me know the answer of this question, please. Question number 6. Question number 6. Okay, wait, good. Everyone, please try to attempt this question. All of the participants are requested to please participate. Ahmed, Filza, Gregory, Hasib, Laiba, Naveen, Noor. Very good, Hasib. Very good, ways. I'll be definitely appreciating your efforts. Laiba, very good. Ahmed, why B, man? Why B? The correct answer should have been D. Okay, let's evaluate. Why not 2? Ahmed, let's try to evaluate. Why not? The second statement is incorrect. Why? First statement, the gain or loss recognized on the measurement or on the disposal of the asset. Don't you think that this information should be presented? Yes, this information should be presented. The post-tax profit or loss from the discontinued operation, we have just discussed it, that the post-tax profit or loss should be reported. The post-tax profit or loss should be reported. And the third one is the related income tax expense on any taxable gain. It means the related income tax expense. This should also be recorded. This should also be accounted for in the financial statement. It means all of these 3 statements should be accounted for. So option D should have been the correct answer. That is 1, 2, and 3. Okay, now let's move on to the another question. Another question that is related to the same scenario, that is related to the same case. Question number 7. What amount should the garden furniture division be measured at the statement of financial position? Again, you guys will be practicing this one. I want you all to please answer this question as at 31st October 2004. At what amount this garden division, which is classified as held for sale. Don't forget, now it's no more a property, plant and equipment. Now it's a non-current asset held for sale. At what value such non-current asset held for sale will be reported at 31st October 2004. And don't forget, at the end of the year, this division was not sold. This division was sold on 12th of January 20x5, that is after the reporting date, which means that non-current asset is held for sale at the end of the accounting period. Information is in front of you. You can see the information on the screen, and I want the answer of this question. Please try this question. I just repeat the requirement. At what value the non-current asset held for sale should be reported in the balance sheet at the end of 31st October 20x4? I want you all to please participate and answer this question. Yes, please, everyone. Be quick. Show the options. Okay, let me show you the options for this one. The options are if students want to take this snap of the screen or the picture of that question, you can, or you can definitely have a picture of that question as well, or the requirement. Asif, I would suggest you to please work out again. Yes, everyone. I want you all to please participate. Okay, ways good. Anyone else, please? Naveen. Good. Anyone else? Yes, Laiba. Noor. Ahmed. Filza. George. Okay, let's try to calculate this one. Okay. We all know that non-current asset held for sale is recorded at the lower of what? The carrying amount or the fair value less cost to sell. Is it? Carrying amount or fair value less cost to sell, whichever is lower. Okay, now let's calculate the carrying amount. The carrying amount of that particular asset is already given. Now the fair value less cost to sell. Now for the purpose, or the examiner wants you to confuse, and for that purpose he has given you the information of value in use, and there is no work for this one. There is no use of it. In examiner has identified this mistake. Many of the students applied the same concept of IAS 36, that they calculated the recoverable amount, that is the higher of fair value less cost to sell, or the value in use, but that's not the case. The impairment, the testing of the impairment in IFRS 5 is completely different. It means now the carrying amount and the fair value less cost to sell. Yes, Mr. Asif, you have made the blunder of it. 26,940 minus 2040. Can anyone please calculate the amount of fair value less cost to sell? What will be the fair value less cost to sell? Please notify me. Fair value less cost to sell. Fair value less cost to sell. That is 24,900. Carrying amount is 31350. Whichever is lower. It means fair value less cost to sell is lower. It means now that particular asset or non-current asset held for sale will be recorded at 24.90. 24,900 was the answer. If you wanted to convert in millions, we are just going to divide it by 1,000. Please divide it by 1,000. This will give rise to 24.90 as the correct answer. Okay, for the sake of understanding, let's complete this entry. Here we go. We have an entry over here. Property, plant, and equipment. The carrying amount of the property was the carrying amount of. Can anyone please call me the carrying amount of the property? What was the carrying amount of the property? Let me go back. Yes, 31350. 31350 was the amount of property, plant, and equipment. 31350. and non-current asset held for sale will be transferred at the value of 24,900. 24,900. The difference will be, what is the amount? What is the difference amount? What is the difference amount? Please, can anyone calculate this one? What is the difference amount? 31350 minus 24900. That is very good. 6450. And that is the amount of P&L. Another requirement that examiner might have asked you, that what amount should have been recognized in P&L in case of this reclassification. Are you guys getting a point? Although it was not required over here, but if the examiner would have asked you that what amount should be charged to P&L or recorded in P&L, this would be the correct answer, 6450. Okay, now let's move on towards the another question related to that particular OT case. Question number 8, what is the weighted average number of shares to be applied when calculating the basic EPS? Okay, now we are moving towards the IAS 33 earning per share. Earning per share. In that standard, we usually calculate two ratios, that is the basic EPS and the diluted EPS. And if you talk about the basic EPS, in order to calculate the basic EPS, the formula to calculate the basic EPS is quite simple. That is the profit after tax divided by weighted average number of shares. And you guys know that the numerator seems to be very simple, as we never find out any complications or the complexities in the numerator side. The important thing is that we need to calculate the weighted number of shares, weighted average number of shares. That is a little bit a difficult task. Now let's calculate the basic. Okay, in this question, we are not supposed to calculate the EPS. We are not supposed to calculate the EPS. What actually the requirement is, what is the weighted average number of shares to be applied? It means we need to calculate the denominator side only. Are you getting my point? We are not supposed to calculate the basic EPS. We are just supposed to calculate or to identify the amount or the weighted average number of shares. So how are we going to calculate it? Let's read out the requirement or the data of the question related to the shares, and then we will try to calculate. Okay. If you could just recall, the discussion regarding the number of shares was started from that paragraph. Is it? On 1st of August 2004, to partly fund the restructuring, 18 million equity ordinary shares were issued at a full market price or the market value. 16 million convertible loan. For the time being, we are supposed to calculate the number of shares for basic EPS. And remember, in that particular basic EPS, we will never account for the convertible loan or the option shares. Yes, this will be accounted for, but for the calculation of diluted earning per share. But right now, we are about to calculate the weighted average shares for EPS, basic EPS. Okay, now the first information that we can see that is given, that is a relevant information. Another relevant information that we can say that, or we can see, that is the number of shares that was given at the start of the year. That is 60 million ordinary shares. The third information that we can see is the point number 2, that company issued bonus shares. So these are the related or the relevant information given for the calculation of weighted average shares. Now, how we are going to calculate the weighted average shares? Okay, let's have a working of it. First of all, we have opening shares. We have opening shares at the start of the year. At the start of the year, the opening shares were, that is 60 million. Is it? 60 million. That is 60,000 shares were available at the start of the year. 60,000 shares were available at the start of the year. And accounting period is starting from November. Is it? Okay. There was no change till I guess the second issue was on March. Yes. Another issue was on in the month of August. It means from November, December, January, February, and March. November, December, January, February, and March. That is still, sorry, on the 1st of March, the bonus shares were issued, which means November, December, January, and February. Only 4 months. From November till February, the ordinary shares were 60,000. The ordinary shares were 60,000 from November till February, which will make around 4 months. Subsequently, in the month of March, there was an issue. And that issue was the bonus issue. And the bonus issue was the number of bonus shares that were issued by the company on 1st March. That was the 1 for 4. 1 for 4. It means you will get 1 bonus shares if you are having 4. You will get 1 bonus share if you are having 4, for 4 already held. Now the concept or the idea that is given by the IS 33, that if the company is issuing the bonus shares in the mid of the year, so this should be treated as if the bonus shares were available at the start of the year. It means if you are issuing the bonus shares, which means that you are issuing the shares at free of cost. You are issuing the shares at free of cost. So IS 33 states that always assume that the bonus shares were issued since from the start of the year. You have to work like as the bonus shares were available at the start of the year. For that purpose, what we do, that we calculate the bonus fraction. And the formula to calculate the bonus fraction is shares after issue divided by shares before issue. Before issue means before bonus issue. Now the company has committed that they will provide you 1 bonus share for every 4. It means if the shareholder is already having 4 shares, he will get 1 more shares, which means now there will be 5 shares. It means shares after issue would be 5, and before issue this would be 4. So it means that 5 over 4 is the bonus fraction, and that bonus fraction should be applied right from the beginning, which means at the start of the year, no doubt the physical shares were 60,000, but in compliance with the IS 33, we will assume that these bonus shares were also presented at the start of the year, which means we will apply that bonus fraction right from the beginning. It means multiply by 5 divided by 4. There could be another way to calculate or to have this calculation. For instance, if we have 60,000 existing number of shares and the company has decided to issue 1 for 4, which means 1 new share will be given for every 4 held. If you just divide it, you will get the answer that is 15,000. It means now the company will not have 60,000 shares. Now the company will have how many shares? That is 75. 60,000 at the start of the year. Further 15,000 bonus shares are issued during this accounting period, which means now the company will have in aggregate 75,000 shares. Another option is that you can have that 75,000 over here, and once you are writing 75,000, then there is no need to apply the bonus fraction. Are you getting my point? Please notify me through our chat box. There are 2 possible options. Either you calculate the number of bonus shares as we did over here, that is 15,000, and then add it up to the existing number of shares and just work out with 75,000. And once you have accounted that bonus shares right from the beginning, then there will be no use of the bonus fraction. Are you guys getting my point? Right now, I am making that situation very simple, and I'm using that bonus fraction. Okay. So now from March onwards, now don't say that we have 60,000 shares. Guys, we have how many shares now? How many shares do we have now? From March onwards, we don't have 60,000 shares. We have how many shares? Yes, everyone, please. 75,000 shares. Exactly. We have 75,000 shares. And please don't forget, there is another transaction. There is another activity. And that was carried out on 1st of August, which means March, April, May, June, July. That means 5 months. 5 months from March till July, which means 5 months. After 5 months, in the month of August, there was another activity, and the activity was that the company issued shares at the full market price. It's not the right issue. It is the shares issued at full market price, and 18 million shares were further raised, which means from August till October. Am I right? As there was no further transaction, no further share activity, it means August, September, and October. That is till October. How many further shares? How many further shares were issued by the company? That is 18,000, which means 75,000 plus 18,000. 75 plus 18. 75 plus 18. Now we have in aggregate how many shares? How many shares? 93,000. And for how many months? August, September, and October. That is for 3 months. That is for 3 months. Now the question is there any need to apply that bonus fraction on these two particular workings? Answer is no. Reason being, if we are having that 75,000 or 93,000 shares, don't forget that those 15,000 bonus shares are already included. So we are not required to apply the bonus fraction on these two workings. There are multiple ways through which these weighted average shares can be calculated. Okay, now please calculate the resultant for these one, please. 60,000 into 4 over 12 multiplied by 5 divided by 4. Please calculate. What will be the answer for this one? 60,000 into 4 divided by 12 multiplied by 5 and divided by 4. And this will make around 25,000. Okay. 75,000 into 5 divided by 12. This will make 31250. And 93,000 multiplied by 3 and divided by 12. This will make 23250. So the total weighted average shares 23250 plus 31250 plus 25,000. That will make 79,000. 79,500. So the weighted average shares is 79,500. That will be used in order to calculate the basic EPS. So let's find out the answer for this one. 79,500. And if you wanted to give the answer in millions, so simple way, that is to divide that amount with the thousands, and you will get the answer of it. That is 79.5. That is option D is the correct answer for this one. Yes, please. Is it clear to everyone? Please notify me through a chat box. Is it clear to everyone? Okay, let's move on towards the last question of this OT case. That is, what are the retained earnings to be applied when calculated the diluted earning per share? Quickly recall diluted earning per share. How the diluted earning per share is being calculated. The formula for the diluted earning per share is the profit after tax plus interest saved. Am I right? That whenever the company has issued the convertible bonds or the company has an option shares, it means in future there will be a saving. There will be a saving, especially in case of the convertible bond. Why there will be a saving? That right now we are paying interest to all our stakeholders who have that convertible bonds. But at the maturity date, let's say at the end of the year 3 or the year 5, what will happen? That these convertible bonds will be converted into the shares if the stakeholders have adopted the option, if the stakeholders have opted for the shares, which means in future now no interest will be given. This will give rise to your profit. This will give rise to your profitability. And remember, if this will give rise to your profitability, your profit will increase. And once your profit will be increased, it means now the tax will be imposed. So that is the formula. That is diluted earning per share, profit after tax plus interest saved minus tax imposed on that interest saved, divided by weighted average number of shares. Right now, we are just supposed to calculate the earnings. It means we need to calculate the numerator side, only the numerator side. We are not supposed the complete ratio. We are not supposed to calculate the complete ratio. Okay, let's quickly move on towards the data. That what's given in the data. Profit for the year is given, that is 103.8 million. 103.8 million. Profit after tax is already given, 103.8 million. Plus interest saved. We have read that information that during the accounting period, company issued $60 million 8% convertible loan notes. It means on that 60%, on that 60 million, if you will apply the 8% interest, effective rate is 8%. 60 million into 8%. This will make 4.8. It means in the near future, when that convertible loan notes will be converted into ordinary shares, that 4.8 million will be a saving. This will increase the amount of profit. And once this will increase the amount of profit on that particular saving, on that profitability, the tax will be imposed. The tax will be imposed, and the tax rate is already given in the question. That is 4.8 million into 20%. 4.8 million into 20%. 4.8 into 20%. That is 0.96. 0.96. Can anyone please calculate the answer for this one? 103.8 plus 4.8 minus 0.96, that is 107.64. 107.64. That is the correct answer. Is it clear to everyone? Yes, please notify me through a chat box. Is it clear to everyone? Ahmed, Filza, George, Asif, Naveen, Noor. Okay, perfect. So that was the OT case. And please make sure, I just told you at the start of the session that these are the difficult and the challenging questions. These are not the normal one. You might have practiced all of these standards and you must gone through the kit questions, BPP and Kaplan and study up, but these are the challenging one. These are the challenging one. You can definitely reach me out personally. I will give you that file. I will give you all of these questions along with the answers. You must try and you must go through all these questions. You must go through all these questions before your exams. Okay, moving on towards the another area, another question. That is question number 10. That is question number 10. Question number 10. And if you will just read out that question, by having just go through of the question, once you will just read out the data, or even you will skim, you will just skim the data, you will find out that that question is related to which standard. That question is related to which standard? Can you guys please? Yes, please notify me. Yes, it's IS 12. Very good. IAS 12. Okay, perfect. Let's quickly read the data. The carrying amount of the asset is given for the plant and land. But the most important thing is that is the cost less depreciation. But in case of a land, we all know that we never calculate the depreciation. We never calculate the depreciation. Okay, so original cost of the land was 200,000. But here the examiner is saying the land is valued at 2,80,000 as per the accounting records. Remember, that is the carrying amount. It means as per the accounting records, as per the accounting records, as per the accounting records. The value of land is 2,80,000. Original cost was 200,000. And we all know that we never depreciate land. So what? Yes, exactly, Asif. Very good. Marvelous. It's a revaluation. That shows there is a revaluation gain of 80,000. That indicates a revaluation of 80,000. Perfect. Let's move on to the tax base of those particular assets. The tax base of the plant is 90,000 and the tax base of the land is 200,000. And the tax rate is 20%. Tax base of plant is 90 and land is 200,000. Tax rate is 20%. Now examiner is saying that the deferred tax liability should have been 20,000 and revaluation surplus is 64,000. So what's the requirement is? The requirement is you need to answer that whether the amount related to the deferred tax liability, whether the amount related to the deferred tax liability, whether the amount related to deferred tax liability is correct or incorrect. It means you have to work out. You have to work out in a normal way as you normally do it. And again, you have to calculate and you have to let the examiner know whether the amount related to revaluation surplus is correct or incorrect. I want your participation. Please try to attempt this question and let me know whether these two informations that is given by the examiner is correct or incorrect. Whether both statements are correct or both statements are incorrect, or one is correct or another one is incorrect. Okay, Hasib, you said that the deferred tax liability is correct and the revaluation surplus information, that is revaluation surplus amount, is incorrect. That is 64,000. Anyone else, please? Okay, Naveen, first one is the correct. And what about the second one? What about the second one? What about the second one? Yes, Ahmed, Filza, Noor. Okay, let's try to calculate one. First of all, deferred tax liability. We will calculate the deferred tax liability. How are we going to calculate the deferred tax liability? First of all, let's calculate the deferred tax liability for the plant. For the plant, we need two things. Number one, the carrying amount, and second one is the tax base. The carrying amount of the plant was 110,000 and the tax base of the plant is 90,000. The difference between the carrying amount and the tax base will give rise to the TTD. And what is that TTD? Taxable temporary difference, or it could either be a deductible temporary difference as well. And how are we going to identify whether it's a taxable or deductible? If the carrying amount is greater than tax base and the difference is taxable temporary difference. Am I right? Okay. Let's apply the tax rate on this one, or we can have we can apply this at the end as well. Okay, land. What about land? The carrying amount of the land is 2,80,000. That is the value of land as per accounting records. And the tax base is 200,000. And the tax base is 200,000. Again, carrying amount is greater than tax base. The difference is 80,000, which is again the taxable temporary difference. In aggregate, overall taxable temporary difference is 100,000 and the tax rate is 20%. So the deferred tax liability, the closing deferred tax liability, even I would say, the deferred tax liability, the closing balance of the deferred tax liability will be 20,000. That shows, yes, you guys were right. The deferred tax liability information is correct. Very good. Now let's try to evaluate the revaluation surplus. Okay. We all know that we have calculated the revaluation surplus amount right away. That is 80,000. And there is no revaluation in plant. There is no revaluation in plant as no information is given over there. So it means the revaluation surplus is 80,000. That seems that the other information is incorrect. But ladies and gentlemen, this is what the mistake was made by the majority of the candidates in their exams. In that particular exam, you just forgot the rule of IAS 12. IAS 12 states that any deferred tax calculated on a revaluation surplus should be charged to revaluation surplus. Which means if we are calculating the revaluation surplus, if we are calculating the deferred tax on that revaluation surplus, which means the accounting entry for that particular deferred tax should have been revaluation surplus debit and deferred tax liability credit. Are you guys getting my point? So any deferred tax on the revaluation surplus should be charged to the revaluation surplus account, which means 20% on 80,000. This will make 16,000. So the accounting entry should have been revaluation surplus debit and deferred tax liability should have been credited with the amount of 16,000. The revaluation surplus that was initially recorded, that is PPE, land, debit and revaluation surplus should have been credited by 80,000. No doubt the revaluation surplus balance was 80,000. But once we are recognizing a deferred tax on that particular revaluation surplus, now that amount will be reduced by 16,000. So the net or the closing revaluation surplus balance would be 64,000. It means that certain or that particular second information is also correct. Both statements are correct. Are you guys getting my point? Please notify me through a chat box. Wake up, guys. This session is for you. These are the silly mistakes. I will not say that you guys don't have information about this one. Definitely you have information of this one. But you just forgot to account for this particular adjustment. You guys must have gone through this adjustment and this type of particular questions. But at times it happens, you just forgot to account for these kinds of adjustments. So please be prepared for this one. Okay, let's move on towards the another challenging question. Question number 11. Question number 11. Quickly read out the question. On 1st July 2007, a company purchased a 5-year loan notes investment with a par value of $7 million. The investment was purchased at a discount of 12%. The loan note has a coupon rate of 5%, effective rate of 7%. Before we complete the whole question, please let me know from which standard this question has been taken. Which standard the examiner is targeting right now in that particular question? Excellent. IFRS 9. IFRS 9. Before I complete the question, let me give you an overview. Let me give you an overview of that particular standard IFRS 9. IFRS 9, that is a financial instrument. financial instrument, one of the most important standard. In this standard, you must have heard about the two main line items, that is the financial assets and the financial liabilities. Because of the shortage of time, I won't be able to discuss right now the financial liabilities. But yes, I just wanted to discuss the financial asset. In financial asset, we have two different options. Either you will be investing in the equity instrument, I'm making a summary of it, or you will be investing in a debt instrument. How are we going to know that whether we are investing in equity or debt? If you are investing or purchasing shares, I mean ordinary shares. If you're purchasing or investing in the ordinary shares, it means it's a financial asset in equity instrument. But if you are investing, remember the financial asset means you are investing. It's an investment. You are purchasing. And if you are purchasing the debt instruments like loan notes, like debentures, bonds, preference shares. So if you are purchasing the debentures, bonds, loan notes, this will be known as what, the financial asset or the investment in the debt instruments. Okay. Now let's quickly recall the strategy that is given by the IFRS 9. If we are having an investment in the equity shares, we have two different options to account for. That is the fair value through P&L, and the other strategy, that is the fair value through OCI. But if we are investing in the debt instrument, we have three different options. Number one, to have amortized cost. Number two, fair value through P&L. Last one, fair value through OCI. When we will be recognizing the investment through fair value through P&L, if we are holding the shares for trading purpose, when will we be using the fair value through OCI? If we are holding the shares for long-term purpose. And when we will be using the amortized cost under the debt instrument, if we are holding the debt instrument for the principal and interest, we'll get the principal and interest at the end of the maturity period and will hold till maturity. So IFRS 9 recommends that you use the amortized cost method. But if it is exclusively for trading, go for fair value through P&L. But if it is for hold till maturity, but you may sell if you get the good price of it. The intention or the business model of the company is that you will hold till maturity, but if you get the good offer, you will sell it. Then go for fair value through OCI. That is the summary of IFRS 9. A quick summary of IFRS 9. Okay, now let's read out the remaining question. Interest is receivable annually in arrears. First of all, let's try to identify whether it's a question of a financial asset or the financial liability. Please notify me through a chat box whether it's a question of financial asset or a financial liability. It's a question of financial asset or a financial liability. Please, quickly. Yes, it's a financial asset. Why? We are purchasing. Always remember the terminology. We are purchasing. Okay, financial asset. Whether we are investing in an equity instrument or the debt instrument. Quick. We are investing in an equity, in a debt. How just you got to know about this one? Yes, there's a loan note. So it means in this particular question, that side is irrelevant for us. We'll be focusing on that side. Okay, perfect. Let's move on. The par value is $7 million. Investment was purchased at a discount of 12%. It means if that is the par value, if nothing is mentioned in the question, that would be considered as a market value. But in that question, it's not the case. We purchased that investment at a discount of 12%, which means we purchased that investment for what price? 6160 Asif. Thank you so much, Asif. Very good. Okay, the loan note has a coupon rate of 5%. Always remember, Coupon rate is applied on the par value. Coupon rate is applied on the par value. And the effective rate is 7% is applied on the invested amount. Invested amount. Invested amount. Okay, the company has an intention. Okay, please now need your concentration. Company has intention to holding the loan note to receive the contractual cash flows. There is no intention to sell. Now, please let me know which method we are gonna to adopt. Which method we are gonna to adopt? Yes, we are going to adopt the amortized cost method. And we all know that for amortized cost, we need to make a schedule. We need to make a table or the schedule. First, we will see what the requirement is. How much finance income should be reported in P&L? Examiner is not asking about the financial asset to be reported in balance sheet. Examiner is asking what amount of financial income will be reported in P&L. Okay, for that we'll definitely be making a table for this one. The first column is year, second column is the opening balance. You guys please try parallel. You should try. I'll be trying as well. So please, you must try this at your own. And the last third column is the effective rate, fourth column is the coupon rate, and last one is the closing balance. And the effective rate that is already given in the question is 7%. Coupon rate that is given in the question is 5%. Okay, year one at the start of the year. Okay, one more thing, that the investment was made in the year 2007. Am I right? 1st July 2007. So accounting period will be ending on 2008. And remember, the examiner has asked you the accounting for the second year. Majority of the student, again, like in the previous questions, you just identified in lease amortization schedule. Many of the candidates answered for the year one, but the requirement is for the second year, that is year two. Okay, opening balance, definitely the opening balance is not the 7 million, it was 6160. Am I right? Opening balance is 6160. One more thing that you need to keep in your mind, if there had been any transaction cost, we must have capitalized it, because the amortized cost states that any transaction cost must be capitalized. But right now there is no transaction cost. Okay, 6160 is the invested amount. 7% will be applied on that 6160. Please calculate the amount and let me know. 6160 and 7%. This will make around 431.2. Let's round it off. That is 431. Coupon rate is applied on the par value, and the par value was 7,000. That is 350. Thank you, Asif. 6160 was invested at the start of the year. 431 is the interest you received it. That means your investment amount was increased, and 350 was paid you in the form of cash. Now the remaining closing balance is 6241. Thank you, Asif. 6241. Let's move on towards the next second year. 6241 is the opening balance. That is the invested amount. 7% will be applied on 6241. 6241. 437. 350 is the coupon amount that is paid. So the closing balance is 6328. Now, can anyone please give me the correct answer for this question? What will be the answer for that relevant requirement? For that particular requirement, what will be the correct answer? 437. Very good. That is 437. And remember, now see the scenario. Triple zeros are already given, so I am not supposed to write 4,37,000. I will be writing only 437. Is this situation or the question clear to everyone? Please let me know through the chat box. Okay, one more requirement. Let me ask you one more requirement related to that question. If I ask you what amount of financial asset that would be reported in balance sheet, what amount of financial asset that would be reported in balance sheet at the end of the year 2009? What amount of financial asset that would be reported? 6328. Nice, very good, perfect, excellent. Okay, let's move on towards another question. That is question number 12. Question number 12. And once you will start to read that question and you will get to know that question is related to, that question is related to, that question is related to which topic? That question is related to which topic? Yes, guys, please let me know. Yes, it's a consolidation area. It's taken from the consolidation area. Okay, let's try to read out the question. Alpha company acquired 80% ordinary shares in Bravo, which means Alpha is the parent company and Bravo is no doubt a subsidiary company. On 1st of September, I always ask you to please just have a recall whether it's a mid-year acquisition or not. If the acquisition is on 1st of September 20x4 and 31st December 20x4 is the date of reporting, which means yes, it's a mid-year acquisition. Mid-year acquisition. And it's not the case 40% ordinary share capital of Charlie company number of years ago. It means it's not a mid-year acquisition, and obviously we know that that Charlie company will be considered as an associate. Okay, on 30th November 20x4, that is during the course of accounting period. If 31st December 20x4 is the accounting period, and definitely it will be starting on the 1st of November 20x3. So during the course of this year, that is during the period, Alpha company sold goods. Alpha means parent company, sold goods to Bravo means subsidiary company, making a profit of 2000. Mark my words, it's not the sale amount, it's not the intra sales, it's a profit amount. It's a profit amount. Are you guys listening to me? Are you guys getting this point? It's not the sale amount. Half of these items remain inventory. Half of these items remain at the inventory. It means that profit is the total profit, and 50% of the goods are still unsold. Very good, Naveen, very good. Which means 2000 into 50%, which will make around 1000, and that is the value of URP. And one more thing you need to consider, that is the goods sold by parent to subsidiary. That is the relevant URP. I normally use the word relevant URP. What? Relevant URP. But if the goods are sold by parent to associate or by associate to parent, remember this would not be the, it's a URP, but this would not be the relevant URP. Are you getting my point? Let me repeat my sentence. Let me repeat my phrase. If we'll be dealing with the parent and associate or associate to parent, if the goods were sold by parent to associate or by associate to parent, let's say that would be the same condition or same examples. 2000 into 50%, that say 1000 is the URP. Yes, that is a URP. But in case of the associate, this will not be the relevant URP. What do you mean by that one, sir? I mean by this one that you have to calculate the percentage of acquisition in associate company, which means 40% will be applied, and that 400 is the relevant URP, which will be eliminated. Are you getting my point? Whenever we eliminate URP in case of the trading with associate company, we always apply a share of percentage. We always applied a percentage of acquisition. Nevertheless, this is not the part of our current discussion. Okay, now the profit for the year ended 31st December 2004 for each company, Alpha, Bravo, and Charlie is already given. That is 80,200, 51,900, and 86,800. What is the requirement? You have to calculate the amount profit attributable to the equity shareholders of alpha company in the consolidated statement of profit or loss, which means you have to calculate the group profit. You have to calculate. We all know that at the end of the consolidated P&L, what we do, profit after tax attributable to. We calculate the profit after tax attributable to group, and second one is the NCI. But right now, examiner is not asking for the NCI, although we know that to calculate the portion of NCI is quite easy. But right now, examiner has asked you to calculate the value of group profit. And how are we going to calculate the value of group profit? For that, let's make a format of it. First of all, in order to calculate the group profit, we need a profit for the parent company. Is it? Further, if there is any adjustment in the accounts of a parent company, as the goods are sold by parent to subsidiary, which means that unrealized profit is in the books of a parent company. That unrealized profit is in the profit of a parent company. So which means we need to have an adjustment of unrealized profit. Then what we will do, we'll take the subsidiary profit. Am I right? We'll take the subsidiary profit, but not the full profit. We'll take the subsidiary profit of post-acquisition months. Yes, that is the point majority of the students were not able to account for. Examiner has clearly identified that majority of the student has taken the full profit of a subsidiary company as the subsidiary was acquired during the period mid-year acquisition, and subsequently 80% will also be applied. That is the percentage of acquisition. Yes, 80%. 80% will be applied. Are you guys getting my point? Please. Will there be any other option? Will there be any other line item? Please let me know. Let me know through the chat box. Will there be any other line item? Will there be any other line item? Will there be any other line item? In order to calculate the group profit, will there be any other line item? Yes, there will be another line item. And what is that? That is the share of profit after tax of associate company. And whenever I use the word share of, it means that is the percentage of acquisition. Why? Let me give you a brief overview. Whenever we have a consolidated statement of profit and loss, don't you recall that we have revenues and cost, and then we have gross profit, and afterwards we include share of profit in associate. That is Sophia. Share of profit in associate, and afterwards we calculate the consolidated profit. Is it? That is the total profit of the consolidated profit, and that is the profit we attribute to the group as well as to NCI. So if we are calculating the group portion, which means that in that particular total profit there is a contribution of associate as well. So we have to account for that share of profit after tax of associate company. We have to calculate that one. Okay, so now the profit of a parent company is 80,200 and unrealized profit is 1,000. This will be eliminated in order to adjust the parent company profit. Subsidiary post acquisition means the total profit of a Bravo company is 51,900, and 51,900 post acquisition months are, that is September, October, November and December, which means 4 months. Multiply by 4, divided by 12, and then 80%. Can anyone please calculate the amount of it? 51,900 multiply by 4 divided by 12 multiply by 80%. 13840. 13840. Share of profit will be added. Reason being, I just gave you an explanation for this one. What if, Mr. Hasib, we have been given with the consolidated P&L? Let's say this is the consolidated P&L. That is the net profit. And in that net profit, there is a post-acquisition profit. There is a post-acquisition profit from associate company. Remember that consolidated P&L, we add a line item of share of profit and associate. And if there had been a net profit, that net profit will be distributed among the group and NCI. Do you remember that one? Such net profit will be distributed. Such net profit will be attributed to the group and NCI. What we were supposed to do, that we usually calculate the NCI. We just usually calculate the NCI, and we just had a balancing figure of group profit. But this time, what the examiner has said, I want you to calculate the group profit. So in order to calculate the group profit, we know that in that particular total profit, there is an element of share of profit and associate. So that's why we are adding that share of profit and associate. And remember, that share of profit and associate is the profit of a group. There is no contribution of NCI. So the profit after tax of associate company is 86,800, and since there is no mid-year acquisition, so 86,800 into 40%. This will make around, can you please let me know the value of it? The 40%. $86,800 into 40%, 34720. So please calculate the group profit. Calculate the group profit. What will be the total value? What will be the total value? What will be the total value? 80,200 minus, subtract 1,000, add 13840 and add 34720. 127790. That is the amount of 127790. That is the amount of group profit. Okay. Can we calculate the NCI? Yes, we can. We can calculate the NCI. Can anyone please calculate the NCI? Although it's not the requirement, the answer of this question is 127790. That is the complete answer. But I want you to please calculate the NCI. What will be the amount of NCI? Can anyone please calculate the value of NCI? It's quite simple. Just recall the basics. Just recall the basics. How are we going to calculate the NCI? Remember the equation of NCI. NCI is the 20% of a subsidiary. As simple as that. There will be no impact of associate in that NCI. Remember, the definition of NCI is 20% of a subsidiary, which means subsidiary's profit is 51900. Again, it's a full year profit. 51900. 51900. And the post acquisition was September, October, November, and December. 4 divided by 12. 51900. 51900 multiplied by 4 divided by 12. That is 17,300. And NCI is 20%. So 17,300 into 20%. That is 3460. 3460. If, for instance, examiner would have asked you about the value of NCI, so that is very easy to calculate the NCI. That is subsidy is 20%. Yes, there could be some adjustment as well. For instance, there would be an adjustment of fair value depreciation or unrealized profit if the goods are sold by subsidiary parent. Then certain adjustment would be required. Then certain adjustments would have been required. and then we must have calculated the 20%. Yes, usually the group profit is the balancing figure, but here the examiner has asked you to calculate the amount of group profit. Is it clear to everyone? Okay, let's move on towards another question. That is question number 3. That is a very easy and the simple question. And that question is related to IAS2. Inventory. Very simple question. I want you all to please answer this question. Please answer this question. It's very simple. It's very simple question. There are 2 lines of inventory that is given. There are 2 lines of inventory that is given in the question. The first paragraph will identify you the first line of inventory, and the second paragraph will give you an information related to the another inventory. And you need to identify the 2 correct statements. You need to identify the 2 correct statements out of 6 statements. Okay, very good. The first part states that the company is manufacturing specialized cycling and cycles equipments are being prepared by the company, and the manufacturing cost is $20,000. Manufactured, these frames were manufactured following an order. Customers agreed selling price is $30,000. $30,000 is the selling price, and these products were produced at a cost of $20,000. Due to the recent technological advances, now the manufacturing cost is estimated to be $15,000. Remember that $15,000 is the replacement cost. It's a replacement value. Again, company also has an inventory of 3,000 pedals with a cost of $20 each. These have been damaged. If the company spends $5,000 to repair all of them, these could be sold at $21 each. Okay, first of all, let's try to find out the equipment, the value of equipment vehicles or equipment specialized frame or equipment. Okay, frames. First of all, calculate the value of frames. How do we calculate? As per IS2, inventory should be recorded at the lower of cost or NRV. First of all, let's have a cost of this, and the cost for that particular frame is 20,000, and NRV, that is net realizable value, selling price less expenses. Only the selling price is given, that is 30,000. No estimated expenses are given over there, which means now the inventory should be valued at lower of, that is the cost. It means frames will be recognized at cost. Now the second line item of the inventory is, that is as inventory of pedals, and again we need to calculate the cost and NRV. Cost and NRV, the cost is $20 each, and we have 3,000 pedals. This will make 60,000. The cost of the pedal is 60,000, and the NRV is, that is the net selling price or the estimated selling price less expenses. So they would be these items will be sold at a price of $21 each, and 21 into 3,000. 21 into 3,000, as we have 3,000 products. 3,000 into 21, this will make 63,000. That is the estimated selling price, but there will be an estimated selling expense of 2,000. I guess it was 2,000 or 5. Estimated selling expense of 5,000. Estimated selling expense of 5,000, which means 63 minus 5,000, that is 58,000. Now that particular inventory should be recorded at the lower of, and now the lower is NRV, that is 58,000. So frames will be recorded at 20,000, NRV will be recorded at 58,000. We need to identify two correct statements. We need to identify two correct statements. Can anyone please identify those two correct statements? Yes, please. The frame should be valued at 15,000. Is it right or wrong? Yes, it's wrong. Frames should be valued at 20,000. Yes, the second statement is correct. Yes, second statement is correct. And the another statement, that is E, the pedal should be valued at 58,000. That is B and E. Is it clear to everyone? It was the easiest question, but majority of the students made out the blunder. And what was that blunder? They recorded the inventory of flames at a value of 15,000. They took as a replacement price or the replacement cost as a lower of. Okay. Let's move on towards the last OTKs of the session. We'll quickly go through this question as the details are given for the factory, head office, and machinery. These are the three assets, and the information related to those assets are given. And one more thing, that the examiner has given you the instruction that the company uses the cost model when accounting for its head office, and deferred income method in relating to the government grant. Okay, if we are talking about the government grant, which means it's IAS 20. And let's read out the data. At 1st January 2007, company's factory had a carrying amount of 5 million. It has a remaining useful life of 10 years. On 31st December 2007, that is at the end of this year, there was an impairment review, which means now we are moving ahead towards the IAS 36. The recoverable amount deemed to be 2.5 million. Company's factory had previously been revalued upward, and the surplus balance had been a credit balance of $1 million related to that factory. Another is the head office, which had a cost of $12 million on 1st January 20X1. That means 6 to 7 years ago, and is being depreciated over a period of 40 years. On 31st December 2004, that is after 4 years, there was an impairment review of a head office, and the recoverable amount was 9 million. A more recent valuation at 31st December 2007. It means soon after 2004, after 3 years, 3 more years, the estimated recoverable amount was 11 million. Again, it's IAS 36. Machinery, on 1st April 2007, company received a grant. It means now in this particular standard, we'll be talking about the IAS 20 of 2.6 million towards the new production machinery. The machinery cost is 4 million and is expected to have a useful life of 5 years. Depreciation is charged on a straight line proportionate basis. And company uses the cost model for head office. It means head office, for head office, it's a cost model. And for grant, we are using the income method for the government grant, which means we will be recognizing the grant as a deferred income. Okay, let's quickly move on towards the requirement side. And the following assets belonging to the company requires an impairment review. First of all, let me recall you regarding the impairment review. Impairment review is being conducted whenever there are indicators. When there are indicators, it could be an internal one or there could be an external one. I repeat, the indicators could be internal or the external. And remember, whenever the impairment review is being conducted, there should be an indicator. But for two assets, there should be no indicators. No indicators are required. And annual impairment review is being done. And what are those two assets? Number one, intangible asset. Very good, Asif. Intangible assets having indefinite useful life. Indefinite useful life. And the other one is the goodwill. We have read out the whole information. Did you find out any intangible asset in that particular scenario or the circumstances? No. Did we discuss anything about the goodwill in that particular question or the scenario? In that particular case, no. So it means annual impairment review is not required even for factory, head office or machine. So the correct answer of this question is option D. Neither the head office nor the machinery requires the annual impairment review. Are you guys getting a question? Are you guys getting it, please? Question number 15. You need to account for the journal entry for depreciation and impairment of factory. So it means that question is relevant for the factory area only. So we'll be discussing, we'll be reading out the data related to factory. Okay, factory was purchased or had a carrying amount at the start of the year is 5 million. Useful life is 10 years. It means in order to calculate the impairment, 5 million is the value of asset, and at 31st December, if we are having an impairment review, which means we need to depreciate it for 1 year, and the depreciation amount would be 5 million divided by 10. 5 million divided by 10, 0.5 million is the depreciation. So the carrying amount at the end is 4.5 million. And the recoverable amount is already given in the question. The recoverable amount is 2.5 million. Recoverable amount is 2.5 million, which means carrying amount is greater than recoverable amount. The asset is said to be impaired, and the impairment loss is 2 million. But don't forget, for head office, company is using the cost model, but it's quite obvious that for factory, company is using the revaluation model, as there had been a credit balance of revaluation surplus of 1 million, which means that impairment loss will be recorded as per IS 36 and IS 16, that we need to reverse back the previous revaluation surplus of 1 million. Very good, Asif. And the profit and loss will be charged to P&L 1 million, and the property, plant and equipment will be credited by 2 million. This will be the accounting entry made for the recognition of impairment loss. But remember, examiner said that you need to account for the correct entry for the depreciation as and an impairment. So you need to calculate the depreciation as well. Depreciation for this current year, depreciation expense debit and property, plant and equipment credit. And we all know that the depreciation for the current year was 0.5 million. Let's compile this entry. Let's club this entry. Let's merge this entry. So the compiled or the compound entry would have been 1 million will be debited by revaluation surplus. P&L will in aggregate be debited by 1.5 million, and property, plant and equipment will be credited by 2.5 million. So that would be the compound entry for the impairment loss and the depreciation. So the correct answer for this one. What should be the correct answer for this one? What should be the correct answer for this one, guys? Yes, it's A. A is the correct answer. Very good, Naseeb. A is the correct answer. Let's move on towards the 16. Question number 16. A simple question and very easy question. The carrying amount of the head office at 31st December 2007. At 31st December 2007, head office. The cost on 1st January 2001 was 12 million. Remember, the 12 million, that means 12,000 was the cost on 1st January 2001. Subsequently, on 31st December 2004, that is 2001, 2, 3, and 4. Soon after 4 years, there was an impairment test. We need to calculate the depreciation for 4 years. And what was the life of that? That is 40 years. 40 years is the life. And 4 years depreciation will be calculated. What will be the amount of depreciation for 4 years? 12,000 divided by 40 multiply by 4. This will make 1200 as an accumulated depreciation. 12,000 minus 1200. 12,000 minus 1200. The carrying amount is 10,800 at the end of the year 4. And the recoverable amount was, what was the recoverable amount? That was 9 million. Is it? Yes, the recoverable amount was 9 million. That is 9,000. The recoverable amount was 9,000. That is the carrying amount. That is the recoverable amount. And if the carrying amount is greater than recoverable amount, the asset is said to be impaired. There is an impairment loss. But remember, examiner is asking the question related to 20x7. It means we need to move forward now. We need to move forward. Now, let's have a look on the data of question. The more recent valuation on 31st 20x7 estimated now the recoverable amount is 11 million. It means 3 more years. 3 more years. That is 2005, 6 and 7. And as per IAS 36, after recognizing the impairment loss, assets will be depreciated at its recoverable amount over its remaining useful life. Very good. Now the remaining useful life is, total life was 40 years, out of which 4 years we have already used. That is 36 would be the remaining useful life. So 9,000 divided by 36 and multiply by 3. Am I right? That is 2005, 6 and 7, which will make an accumulated depreciation of 750. So 9,000 minus 750. So the carrying amount would be 8250. 8250 is the carrying amount. And the recoverable amount that is given in the question was 11 million. 11 million. 11 million. Recoverable amount is 11,000. Wait. Impairment loss. When the carrying amount is greater than recoverable amount, here the scenario is reversed. There is a different scenario. There is a recoverable amount which is greater than the carrying amount. It means there is no impairment loss. Although there is a situation or the condition of reversal of impairment loss. Now the most important point is, company is using the cost model. This would have been very easy if the company would be using the revaluation model. That situation would be quite easy. But right now here, the reversal of impairment loss, but there's a cost model. Although if I just calculate the depth, if I just calculate the difference of 11,000 and 8250, what normally I think that there should be a reversal of 2750, but that's wrong. IAS 36 states that if the company is using the cost model and you are having a reversal of impairment loss, now what you have to do, you have to increase the carrying amount of the asset. Right now the carrying amount of the asset is 8250. Now reversal means you will increase the amount of asset. Increase the amount of asset to the lower of number one, carrying amount if there had been no impairment, or the recoverable amount, whichever is lower. What does it mean? Carrying amount if there had been no impairment. Let's evaluate. If we just evaluate that the value of that asset is 12,000 at the start of the year 2001. Since 2001, 1, 2, 3, 4, 5, 6, and 7. We use that asset for a period of 7 years. Assuming if there had been no impairment, during any course of the year, any period, so 12,000 divided by 40 multiplied by 7, 2,100 would have been the accumulated depreciation. And today at 31st December 20x7, the carrying amount of that particular asset would have been 12,000 minus 2,100, which means 9,900. That would have been the carrying amount if there had been no impairment. And what is the recoverable amount? That is already given in the question. That is 11,000, I guess. Yes, it's 11,000. So 9,900 is the carrying amount if there had been no impairment. And recoverable amount is 11,000, whichever is lower. So lower is 9,900. So the value of asset should be increased to the value of 9,900, which means the reversal of 1650 be only recorded. There are multiple reasoning for this treatment. It's not the right time, or we don't have a plenty of time so that we can discuss it, but there are reasons for this rule. So the value of that particular asset should have been 9,900, which means 9.9 million should be the value of asset. Is it clear to everyone? Please let me know. Question number 16. Now that's another question that is quite easy. You can just answer me. It's a theoretical question related to IAS 20. It's a theoretical question related to IAS 20. It's a theoretical one. Deferred income should always be used for grants related to asset. It's not the case. We can use deferred income for revenue grant as well. Grant related to income must be disclosed separately in the statement of profit and loss. No, this could be adjusted in the related expenditure. If you guys remember, related expenditure, we have income method and expense method. There are two options that is given by the IAS 20. Either you can record that income as another income, or you can even reduce the related expenditure. So second option is incorrect. Third one, deferred income should only be used if the grant is repayable. It's not the case. Deferred income is used in any case, whether the grant is repayable or not. D, the grant related to asset can be accounted for using either the deferred income method or by deducting. Yes, it's a gross method, and the second one is the net method. So the fourth statement is correct. That was the easy MCQ or the theoretical MCQ. Okay, last question of that particular scenario or the OT case. What carrying amount of the non-current liability in respect of the government grant in the statement of financial position at 31st December 2007 should be reported? Let's quickly read out the data related to that particular grant. On 1st April 20X7, that is in the current accounting period, company received a grant of 2.6 million. Company received a grant of 2.6 million. Okay, 2.6 million, that is 2,600. The grant received for 2.6 million for the purchase of an asset. It means it's an asset grant, and the life of the asset is 5 years. Always remember, the grant will be released based on the method of depreciation, and the depreciation is a straight line. So the grant will be released over the period of 5 years, and from April till the accounting period is December. April, May, June, July, August, September, October, November, and December. That is 9 months. This will be proportionated. So 2,600 into 5, 2,600 divided by 5, multiply by 9, divided by 12. 390. 390 is the amount, as we are using the deferred income approach. So 390 will be released from deferred income to other income, which means the total grant of 2,600, out of which 390 is released during this period. Now 2,600 minus 390, that is 2210, is the deferred income closing balance. But remember, that is the closing liability. That is the total deferred income. What examiner was asking that you need to calculate the long-term non-current liability. Non-current liability. You need to calculate the non-current liability for this one. So 2210 is the deferred income, and we know that in the current or in the next accounting period we will be releasing the deferred income, and the life was 5 years. So in the next accounting period, that is 2,600 divided by 5, in the next 12 months we will be releasing 520, and definitely after the 12 months, 2210 minus 520, 1690, 2210 minus 520, that is 1690, is the non-current liability. If the examiner would have asked you regarding the current liability of deferred income, the answer would have been 520. But right now the requirement is non-current liability. 1690 is the answer, and if you want the answer in millions, let's divide it by 1000, which means 1.69 million is the correct answer. So this was all from this session, practice to pass webinar, and these were the most difficult questions, or we can say that these were the challenging questions that examiner has identified in their examiner's report. I hope that this session was quite beneficial and useful for you guys, and you must have been benefited from this session. Let me share you the contact number, and if you have any problem, and if you want that data or these particular questions, you can definitely reach me out. You can definitely reach me out by contacting me through my WhatsApp. Sorry for the delay in session, as we have spent a lot of time. That is my number. You can definitely contact me out personally. I'll try to help you out in different situations or the circumstances. Thank you so much for joining this session. And I believe and I pray to Almighty Allah so that you get successful in your respective exams, in your upcoming exams. Thank you so much. Allah Hafiz.